Good morning, everybody. This is lecture for week 11, lecture 1, Monday, 4th of January 2021. Happy New Year to everybody. It is like raining everywhere now. I hope you are fine. And we will start a new chapter today. So, the new chapter is topic 6, accounting for manufacturing. Topic 6 is the first topic for management accounting. Remember I have told you at the beginning of the semester, in this course you will learn about two main branches of accounting, financial accounting and management accounting. In topic 1 to topic 5, you have learned mostly about financial accounting. The first thing that you have learned in topic 1 to topic 5 is you have learned about the introduction to accounting, and then you have learned about how to do financial accounting. When you learn about the how to do financial accounting, you have learned about the accounting cycle from step 1 to step number 8. And then in topic 5, you have learned about financial statement analysis. You have learned you know that the output of financial accounting is financial statement. And then in topic 5, you learn about how to analyze the financial statement. So now in topic 6, you are starting to learn about management accounting. Okay, just remember several important things about management accounting. Management accounting is done is done by management accountant, and the output of management accounting, there are two main output. The first one is budget, and the second one is cost report. Okay, remember this. Management accountant, they work in a business. They help manager to make business decision. So, if manager asks about or ask the management accountant to prepare budget, then the management accountant will prepare budget. If the manager asks management accountant to calculate cost, then the management accountant will have to calculate or to prepare cost report. So, management accountant do work for managers, to help managers to make business decision, to help managers to manage the business. Okay, so let's see. So before you learn about management accountant, like I said earlier, the main point is you have to know that a management accountant works for manager. So the first thing is you have to know what are the main activities of a manager. Let's say you are a manager in the future. You are a manager in a big company. So you have to know what are the main activities for a manager. So the work or activity of a manager, there are 3. The main work or activity for manager, there are 3. The first one is a manager has to do planning. The second thing is manager has to do directing and motivating. And number 3 is manager has to do controlling activities. So a manager So this is the detail about the three works or functions of manager. The first one is planning. So a manager, most of the time, is responsible to make planning for its department or its division or the whole business. So if you are working as a manager in the future, that is the main thing that we will have to do. You have to plan for your business or your department or your division or anything. So the basic thing about planning is planning can be divided into long-term planning, I think short-term planning, and maybe mid-term planning. In accounting, uh, when we talk about planning, the steps in the preparing or doing the planning is like this. First, you have to identify alternatives that you want to do in the future for your business or division, and then select alternatives that does the best job for furthering organization's objectives. And the third step is develop budget to guide progress toward the selected alternative. So in accounting, the thing that we use to do planning is budget. If you take business courses, you will learn I think many planning strategies. But in accounting, when we say planning, we most of the time use or refer to budget. Like our country, every country, every year government will prepare budget. The budget is used as a tool to plan for the future of the country. So for a business, the same thing also applies. Every year a business will prepare budget, and then that budget is used as a tool to plan the future of a business. Okay, the second activity of management or work of managers is to do directing and motivating. The thing is like this: if you are a manager, first you have to plan, and then the second thing is you have to do directing and motivating. As a manager, you will have workers to run the activity of the business. So you have to have a plan, and then you as a manager, after you have the plan, you have to direct the workers to do directing, to ask the workers to do this, to do that, to produce this product for how many quantity, for what specification, and etc. And then when you work with people, when a manager works with people, the manager has to do the directing, and at the same time the manager has to do motivating activities. The manager has to motivate the workers to work hard and to work hard for the business to achieve the objective of the business. So let's see here. Directing and motivating involves managing day-to-day activities to keep the organization running smoothly. So, to do the directing, it is done to ensure that employee work assignment, routine problem solving, conflict resolution, effective communication. So that these are the things that a manager has to do. Motivating is a very important function of a manager. If you are a manager, you have to direct your workers or ask workers to do things At the same time, you have to know how to motivate the workers. Workers are not machine. If you work with machine, you just set the thing that the machine has to do and turn on the electricity, the machine will do everything according to your needs. You want the machine to produce 100 product in one day, the machine will do that. So that is no problem. But when a manager works with people, the manager has to motivate the people. People need motivation. If we do not motivate people, or if you do not motivate your workers, then the productivity will become low. So to increase the productivity, one of the things that has to be done is to motivate the workers. In management, I think there is a concept of carrot and stick. When you have to motivate people or workers, you have to use carrot and stick approach. Carrot means you have to reward the workers. Let's say you are a manager, and then how to one of the way to motivate the workers is to reward them. You have to do something like this. You promise to them, if they works or their productivity is high, then you will reward them with bonus, salary increment, etc. And the second thing that you have to do is to use stick. If they do something that could negatively affect the business, then you have to punish them. They are supposed to if you are a manager, you have to have if you are a manager, you have to ensure that a worker that do something that can have negative effect to your business, this worker has to face punishment. So you use carrot and stick, rewards and punishment, so that workers will do their work well. If not, so very difficult to make sure the workers work hard for the business. Okay, and then controlling. Okay, so first you have to know what is control. The control function ensures that plans are being followed. Feedback in the form of performance report that compare actual results with the budget are essential part of the control function. Okay, controlling function. Controlling. What is controlling activity? So the simple way to explain about controlling activity is like this. If you are a manager, controlling means you compare the actual results of your business with the budget. Let's say the budget says for this month of January, the business has to make sales $100,000. So that is the budget. And so this, after the business has the budget, during the January, the business run its operation. The workers has to do works, machine has to produce products, etc. So at the end of January, you stop and collect the data. You compare what is the actual sales and you compare the number with the budgeted sales. Let's say at the end of January, the actual sales is $110,000. The budget is $100,000 sales. So that situation, controlling activities means you compare the actual number and the budgeted number. So if the actual sales is higher than the budgeted sales, then you know that the situation is good, because your business can sell more than the target or budget. Okay, but if you compare the actual number, let's say, okay, but if let's say the situation is like this, the actual sales at the end of January for the month of January is $90,000, but the budget is $100,000, then that situation is not good, because the actual sales is 10,000 less than the budgeted or target sales. So controlling activity, when you compare that, if the situation is good, then it is good. But if the situation is not good, like the sales is 10,000 below the budget, then you as a manager has to do correction and improvement, to make sure that in the next month, your business or division or department perform better than the budget, or at least equal or same like the budget. So in summary, the function of manager, there are three, like I have explained. First, if you're a manager, the first function is, or your first work is to plan for your business. After you have the plan, you do the directing and motivating. Directing and motivating means you ask your workers to do this thing or do that thing related to the production, and at the same time you have to motivate the workers. And at the end of the accounting year, you stop and you do controlling activities. Controlling activities is like this: you compare the actual result for your department or business with the budgeted number. If the actual result is better than the budgeted number, then it is okay. But if the actual result is less than the budgeted number, like the budgeted sales is 100,000 but your business only can sell 90,000, then if that is the case, the situation is not good or unfavorable, and then you as a manager has to do correction and improvement, to make sure in the future your business or division perform better than the budget, or at least equal to the budget. Okay, so now that is the function of manager. Management accountant is an accountant, and the responsibility of a management accountant is to help the manager to do all these management activities or function. Okay, so this is the next thing in this chapter. Okay, now this is comparison of financial and management accounting. Very important. You have learned about financial accounting. Now you will learn about management accounting. So you have to know the difference between these two branches of accounting. So the first thing, I think the most important thing is like this: what is the output? The output. Okay, just remember the output. The output of financial accounting is financial statement. You have learned about that. You have learned about financial statement. The financial statement contains income statement, balance sheet, statement of equity, statement of cash flow, and notes to that account. But okay, remember this: management accounting, the main output of management accounting are two. First, budget, and the second one is cost report. So if you are working as a management accounting, management accountant, the output or the end results of your work are mostly related to these two things. You have to prepare budget. Budget is related to planning for the business, or you have to prepare cost report. Cost report means you have to calculate cost for production. For a business, cost is very important. If you for a business, they have to know exactly how much is the cost to produce a product or a service that they provide. Very important. Okay, so that is the output. So, and then this the user. So see the first point there. Financial accounting, the user is mostly external users. You remember when you prepare the financial statement, for a company has to be published to the people outside the business. So the main user of financial accounting is external user. But for management accounting, the main user of the management accounting information is the internal user. I have explained to you the thing. The output of management accounting are budget and cost report. The user mainly the user is the internal user. The user of the budget and cost report is the manager. Manager needs this budget and report to help them to manage the business. You cannot disclose a business budget and cost report to other people outside the business. That is the business secret. Budget and cost report of a business is the business secret. You cannot show these two things to people outside the business. Okay, time focus. Let's see. Time focus. So for financial accounting, the time focus is history or past. Remember when you learn about financial accounting, when you prepare the accounting record, you record the things that had happened. I always told you, in accounting, for financial accounting, when you record things that had happened. When the transaction happened, you record. So but in management accounting, the time focus is most of the time future. When you learn about management accounting, you always try to things related to the future. When you prepare the budget, you have to focus on the future. What you want to do next month, what you want to do in next 6 months, what you want to do in next 1 year. So the focus most of the time for the future. And then number 3, verifiability versus relevance. Okay, for financial accounting, remember when you do the recording process, I told you that in financial accounting, you record transaction when you do the record when there is a business transaction. So how to say that there is a business transaction? You have to look at the source document. When there is a receipt or voucher or credit note or debit note, that shows that business transaction had happened. So for financial accounting, the emphasis is on the verifiability. But when you learn about management accounting, you will know that the emphasis is on the relevant. You will do calculation for relevant data only. If the data is not relevant, you will not include them in the calculation or in the budget or in the cost report. And then number 4, precision versus timeliness. Okay, when you for financial accounting, the emphasis is on the precision. Everything must be accurate. Remember when you do the journal entry, the ledger, the trial balance, etc., everything must accurate. If you put a wrong number, then your your record will be wrong. Your balance sheet, the total asset in the balance sheet will not equal to the total liability and equity. If so, every item that you record when you do financial accounting must be accurate or precise, or focus on precision. Okay, that is when you do the financial accounting. But for management accounting, most of the time the focus is on the timeliness. Everything has to be done or calculated quickly. Why in management accounting the focus is on timeliness, not accuracy? The focus is on timeliness because you prepare the data for manager. In management accounting, the user of the management accounting output is the manager. Manager wants information quickly because they have to make business decision very quickly. So that's why in management accounting the focus is on timeliness. You have to do things quickly. Sometimes the thing that we use in management accounting is not very accurate, because we have to make estimates. But the most important thing is you have to do it quickly so that manager can make business decision fast, and the business can perform well. If manager cannot make decision quickly, then the business operation is not smooth, and the business will have problem. Okay, the subject here. Okay, but I want to focus on this. The next thing, number 6. Okay, for financial accounting, when you do financial accounting, you must follow GAAP and prescribed formats. GAAP means the accounting standard. So I also have told you this. Actually, when you do financial accounting works, when you prepare the income statement and balance sheet, you have to follow accounting standard. Every business has to do the recording process and has to prepare the financial statement using the same format according to the accounting standard. But when you do for management accounting, there is no need to follow accounting standard, because management accounting information is used by internal user only. It's used within the business only. So when you do management accounting activity or work, you don't have to follow accounting standard, but you have to do things according to the needs of your business or according to the needs of the manager. And then number 7, remember this. Financial accounting is mandatory. In all countries that I know, Malaysia, Indonesia, China, USA, UK, Australia, New Zealand, etc. In these countries, there are law and regulations that require every business to publish their financial statement, to prepare their financial statement and publish their financial statement. So it is mandatory. But for management accounting, it is not mandatory. There is no law and regulation requires businesses to do management accounting work, or to prepare budget, or to calculate costs. There is no mandatory law and regulation. But if the business wants its operation running smoothly, then the business has to use management accounting. If the manager wants its business or its division to make profit and to run efficiently, then the manager has to use budget, has to calculate costs, etc. And the manager has to use the management accounting output when the manager want to run the business. So it is not mandatory, but if a manager or a business wants to get benefit from management accounting, then the business has to use management accounting. Okay, this is the first thing. The first thing that you have, another thing that you have that is very important in management accounting is you have to know about cost. Cost is very important. If you have a business, you have to know about cost. High cost means lower profit. Low cost means you can get high profit. That is the general idea. So cost is very important. When you learn about management accounting, most of the time we focus on manufacturing business. So manufacturing business means a business that produce something. So let's see, this is very important. So cost. Identify and give examples of each of 3 basic manufacturing cost categories. Okay, now see the manufacturing cost. So manufacturing cost means the cost that a business use to manufacture a product. Let's say in the future you start a business, your business produces frozen food. So manufacturing cost means the amount that your business has to pay to produce the frozen food. So let's see. So in management accounting, when you produce a product, you have to pay 3 costs. First, direct material cost. Second, direct labor cost. And number 3 is manufacturing overhead cost. So for example, there is a business. The business produces car. So according to management accounting, to produce the car, the business has to pay direct material cost, direct labor cost, and manufacturing overhead cost to produce the car. Okay, what is a direct material cost? Direct materials are materials that become an integral part of the product and that can be conveniently traced directly to it. So the simple definition is like this. Direct materials are the things that you can see in a product. When you see the product, you can see all the direct materials. So in here, the example is a car. The business is producing cars. So what are direct materials? The direct materials are the things that you can see in the car. When you see the car, you can see the direct material. Here you can see the tires, the engine, the chassis, the window, the windshield, the wiper, the sound system or something. So these are direct materials. So what are the direct material costs? The direct material costs are the amount that you pay to get the material. If your business is a frozen food business, so what are the direct materials? Direct materials are the things that you can see in your product. So what are the direct material costs? The direct material costs are the amount that you have to pay to get the direct material. Let's say your product is frozen donut. So when you see the frozen donut, what are the direct materials? You can see flour, you can see sugar, you can see what else? Butter maybe, I don't know. So these are the yeast. So these are the direct materials. What are the direct material costs? The direct material costs are the amount that you have to pay to get the sugar, flour, and etc. Okay, so direct material. And then the second cost that you have to pay when you produce something is the direct labor cost. Okay, now first, who are the direct laborers? Okay, direct laborers are labor. Okay, remember this. This is the simple definition for direct labor. Direct laborers are workers who involved in the assembly of a product. Direct laborers are workers who are involved directly in the assembly of a product. So here the example is the product is car. So who are the direct labor? The direct labor are people who touching the car, who assemble, who involved in the assembly of the car. So most of the time we say that the direct laborers are the factory workers. They involved directly in the assembly of the product. So these are the direct labor. And what are the direct labor costs? Direct labor costs are the amount that the business pay to this direct labor. Most of the time, the direct labor salary or cost is paid according to the labor hours. Maybe the salary is $10 per hour. So one day the workers are working 8 hours. So the labor cost is $10 times 8 hours. So $80 per day. That is the way to calculate the direct labor cost. In a business, there are many workers. Only some of the workers can be categorized as direct labor. These direct labor are people who are involved directly in the assembly of the product. But people like janitor, security guards, engineers, supervisors, they are workers in a factory or in a business, but they are not direct labor. They are called indirect labor. They are working in a factory or a business, but they are not involved in the assembly of the product. So these workers are called indirect labor. In the later slide, you will know the definition of indirect labor. So the third cost, the third manufacturing cost is called manufacturing overhead cost. Okay, manufacturing overhead costs are manufacturing costs that cannot be traced directly to specific units of product. So the typical examples of manufacturing overhead, like this. Manufacturing overhead costs can be divided into 3 categories. The first one is indirect material. The second category is indirect labor. The third category is other costs. Okay, so remember, manufacturing costs are costs that cannot be traced directly to a specific product. For example, here the example is a business. This business produces car. So manufacturing overhead costs are costs that cannot be seen directly in the when you see the car. There are three types of manufacturing overhead costs. The first one is indirect material. Indirect material is like this. Indirect materials are materials used to support the production process. For example, lubricants and cleaning supplies used in the automobile assembly plant. So you see the box in the left side of the slide. That is the definition of indirect material. So the thing is like this. When for this car manufacturer, in the factory that they used to produce the car, the business uses things like lubricants when the business maintain the machine, and cleaning supplies used in the when the business clean the factory, etc. These materials are costs to the business, but these materials are not used to produce the car. So these materials is categorized as indirect material. The amount that the business pay to get or to purchase these indirect materials are called indirect material cost. So like I said earlier, if you have a business, you produces frozen food, then the direct material is flour, sugar, etc. But in the factory that you use to produce the donut, the frozen food, you have to use things like lubricants to maintain or to clean your machine, and you have to use cleaning supplies to clean all the factory flour, etc. So this material are indirect material. The amount that you pay for these materials are called indirect material cost. Okay, the second category of manufacturing overhead is the indirect labor. So before this, I have to as I have explained in the previous slide, I have explained about the direct labor. Direct labor are people or workers who are directly involved in the assembly of a product. But indirect laborers, they are like maintenance workers, janitors, and security guards. They work in a factory, but they do not involve in the assembly of the product produced in the factory. So the salary paid to this indirect labor are called indirect labor cost. And indirect labor cost is a manufacturing overhead cost. Okay, number 3, there is another category for manufacturing overhead. Other costs. Other costs is like rental. You have a business, you produce something, you rent the factory building. The rental cost is also a manufacturing overhead cost. Another one is depreciation. If you have a factory, you will have many machines. So every year you have to calculate the depreciation for this machine. So the depreciation cost is a manufacturing overhead cost. Another one is utilities like water, electricity. Most of the time, these utility costs are categorized as manufacturing overhead costs. Okay, if there is a question like this, the question asks you, what are 3 costs that has to be paid when a business producing a product? So the answer is direct material cost, direct labor cost, and manufacturing overhead cost. Or in another way, if there is question like this, what are the three manufacturing costs? Or so what are the three manufacturing costs? So the answer is direct material cost, direct labor cost, and overhead cost. So, or another question, how to calculate the cost of a product? So the answer is, to calculate the cost for a product, you have to add direct material cost plus direct labor cost plus overhead cost. Then you will get the total cost to produce a product. Okay, so these are two non-manufacturing costs. So if you have a business, if you have a manufacturing business, our example is you have a business that produces frozen food. So when you have this kind of business, it is like you have a business with factory. So manufacturing costs are costs that you pay in the factory, but at the same time, when you run a business, you have to have a management office. You have to have a management office to manage the marketing, the sales, the human resource, the information system or IT department. So when you have this kind of business, you have to pay two types of costs. First, manufacturing costs, the cost that you have to pay to manufacture or produce the product. And the second type of cost is called non-manufacturing costs. These are the costs that you have to pay when you manage the business. Non-manufacturing costs can be categorized into two types: selling costs and admin costs. So selling costs, see here in the slide, the left side of the slide, selling costs. Selling costs are costs necessary to secure the order and deliver the product. Any cost that you pay to get orders from customers and to deliver product to customers, these costs are categorized as selling costs. Other than the selling costs, the costs can be categorized as admin costs. Admin costs are all executive, organizational, and clerical costs paid by a business. So, how many categories of costs that you have learned? You have learned about two categories of costs. First, you have learned about manufacturing costs. The second category that you have learned is non-manufacturing costs. Okay, this is the third category. Costs also can be categorized as product cost and period cost. Okay, let's see. This is very easy. Okay, product cost. Product cost, okay, this is the definition of product cost. Product costs are direct materials, direct labor, and manufacturing overhead. Product cost means the cost that you have to pay to produce a product. So remember this, product cost equal to direct material and direct labor and manufacturing overhead. So if there is a question ask you, what are the product costs, or what are the costs that a business has to pay to produce a product? So the answer is direct material plus direct labor and manufacturing overhead. Another category of cost is called period cost. Period cost includes all selling costs and admin costs. These costs are called period costs because most of the time a business has to pay this cost periodically. Like okay, one of the example of period cost is selling and admin cost. So one of the example of selling cost is salesperson salary. So a business has to pay the salesperson salary every month. So it shows that this cost is or has to be paid periodically every month. Has to pay the sales cost, the salesperson salary cost. Human resource manager salary also has to be paid every month or periodically. So that's why the non-manufacturing cost is also called or categorized as period cost. But product cost, remember this, product cost, the business has to pay the product cost every time one product is produced. Every time one product is produced, the business has to pay the direct material cost, direct labor cost, and overhead cost. So it is product cost. Period cost is paid periodically. So just easy to remember. If there is a question asks you what is period cost, then the answer is period cost equal to selling cost and admin cost, because they are paid, most of the time they are paid periodically. So this is the third category of cost. So you have seen 3 categories of cost. Okay, this is sample, like a quick check or exercise. So the most important thing in this cost category is, if I give you a list of costs, let's say I give you a list of 10 costs, so you have to know which one is manufacturing cost, which one is a non-manufacturing cost, and which one is product cost, and which one is period cost. So let's see this picture. There is a list of 5 costs, and the question asks you which of the following costs will be considered a period rather than product cost in a manufacturing company. So remember I told you, when you see the term period cost, you have to know that this cost are non-manufacturing costs and they are paid periodically. So see here, A, manufacturing equipment depreciation, is it a period cost? No. A, manufacturing equipment depreciation is a manufacturing cost. It happened in the factory of the business. B, property taxes on corporate headquarters. Okay, B is an example of period cost because it is a non-manufacturing cost and it's supposed to be paid periodically every year. So B is a period cost. C, direct material cost. No, direct material cost is a product cost. D, electrical cost to light the production facility. D is also not a period cost because it is related to production. E, sales commission. So sales commission is a period cost. It is a non-manufacturing cost and most of the time it is paid every month to the salesperson. So the answer for this is B and E. These two are period costs. Okay, this is another categories of cost or classification of cost. Okay, this is related to manufacturing cost. You have to memorize this. So you know that manufacturing costs are 3: direct material and direct labor and overhead. So direct material plus direct labor is known as prime cost. It is known as prime cost because these two costs are the most important cost that a business has to pay when the business producing a product. If you have a business in the future, so our example is you have a business that produces frozen food, you will know that the biggest proportion of the cost are direct material cost and is the direct material cost and the direct labor cost. These are the biggest portion of the cost that most businesses pay during the production process. So these two costs, direct material cost plus direct labor cost, are the biggest cost, so they are known as prime cost. And then direct labor cost plus manufacturing overhead cost is called as conversion cost. Direct labor cost plus manufacturing overhead equal to conversion cost. Why we call these two costs as conversion cost? Because direct labor and manufacturing overhead costs are needed to convert the raw material or direct material to become a finished product. So another way to say it is like this. If you have a business, to convert the raw material to become a finished product, you need direct labor and overhead. So that's why direct labor cost plus manufacturing overhead costs are known as conversion costs. Okay, this is like a revision to you. Like I said earlier, when you learn about management accounting, most of the time the focus is on manufacturing businesses. Why? Because manufacturing businesses produce something, and they have you will learn about how what the cost related to the production process. So what is the difference between a manufacturing business and a merchandising business? Always remember, a manufacturing business is a business that purchase raw material, process the raw material, and produce finished product. But a merchandising business is a business that purchase finished goods and sell the same thing to customer. The typical example for a merchandising business is a grocery shop. So a grocery shop purchases rice, bread, sugar, flour, and sell the same things to customer. But a manufacturing business purchase raw material, process the raw material, and produce finished product, and sell the finished product to customer. So for a merchandising business, in the current asset, the business will have one type of inventory only. The inventory is finished goods or merchandise inventory. But for a manufacturing business, in the current asset, the business has three inventories. A manufacturing business has raw material inventories, work in process inventories, and finished goods inventories. If you have a manufacturing business, our example is you have a frozen food business. So at the end of the year, when you close your account, you will see that your business will have three types of inventory. When you close your account, you can see in your business you have raw material inventory. You have rice, sugar, flour, butter maybe. So these are raw material inventories. And the second type of inventory that you have is works in process inventory. Work in process inventory, partially finished product, and also you will have finished goods. Finished goods inventories are product that are ready to be sold to customer. Okay, you can see in this slide the definition: materials waiting to be processed, and then partially complete product, and then finished goods are completed products awaiting sale. Okay, I think I will stop here. This is the end of lecture 1 for this week. Do not forget to write your name and metric number in the comment section. That is your attendance for this lecture. Thank you very much.